You know, for a few years there, we almost never had 2% daily moves in stocks. In fact, I think we broke some records for like boredom or lack of volatility. But as we talked about in the previous segment with Tim, in the past 2 weeks, and you've noted this, nearly half our trading days have seen moves of 2% or more. What the heck is going on?
Yeah, and the month of May hasn't been pretty either. So it's been a rocky ride for investors, really nerve-wracking for sure. It's something, like you said, we haven't seen in a while. That said, this year volatility has obviously ticked up. But I think it really is a reflection of investors really grappling to figure out the direction of the market here. There's a lot of uncertainty here. There's a lot of question marks about where growth goes from here. Are we going to see a massive slowdown that's led by the Fed? Or can we stabilize after a period of slowing down from really high record rates of growth going forward? And so I think the jury is still out and really trying to figure out what the Fed's going to do.
Lindsay, what's the Fed going to do? I mean, Jim Cramer last night saying they just go big, get 1%, 100 basis points, do it, rip the Band-Aid off, get it out of the way. Do you agree, or do we just have this Fed drag all year, parsing every word from every Fed speaker every day?
That sounds like a really fun way to spend the rest of our year, Brian, for sure. But
sorry,
I'm in the camp that the Fed, look, they're using forward guidance and they're using their rhetoric. We saw that this week to be very hawkish, really show their commitment to raising interest rates in a fast and furious way to tamp down inflation. They're really committed to lowering prices here. Now, the question is, will they be able to move as fast as they're talking? Will the talk be enough to really dampen demand and do the job for them ahead of actually raising rates? Because the fact of the matter is they don't have a lot of tools in their chest to really help the economy if we are going into a recession or a massive slowdown. Interest rates right now are still very low, and moving very quickly is going to slow down the economy much quicker than anyone really would like to see. And then it would put them in a more difficult position because they wouldn't have a lot of ammo to work with if we are in that recessionary environment. It's a tough place to be in, Brian.
Yeah, what do we do, I guess, is... Yeah, I mean, I'm sorry to be sort of this, I feel like the Grim Reaper lately talking about it, and that it's not a fun way to spend the summer. It'd be fun if stocks went up a little bit and we could kind of take a step back and breathe. You wonder how much of these declines, Lindsay, because we all know the markets are moving faster than ever, like we talked about with Tim Quast. I mean, things are happening in a period of days or weeks that used to take months. Even if we get a recession next year, when would the market theoretically be done pricing that in? Because it's going to move now, not later.
Right. The market is always anticipatory of things like a recession or slowing growth rates. And I think that's what you're seeing right now as we're trying to figure out if we're entering into that environment. So I think for investors, I think the first thing you have to do is, accept that we're going to be in this volatile environment until we have more clarity on where the future takes us. And we haven't been in this type of situation where we can't see into the future or have some sort of clue into where we might be headed in a very long time. So that's why you're seeing massive moves in the market. Investors are clinging on to any little data point that they get. This morning, it's the China news cutting rates on their prime loan rate. And so I think you're going to continue to see that jumpiness on various data points. And so the best way to deal with that is really to have a diversified portfolio, have your defensive exposure, have some exposure to dividends, high-paying, high-quality names. But at the same time, we're already down nearly 20% in the S&P 500. You can consider picking at some of those names that have fallen even more than that at this point in time that still remain of high quality and good cash flow. So that's the recommendation I'd make to investors.